Hey guys, Travis here with another conversation around crypto taxes. Today we're going to be tackling how is DeFi taxed? So, unlike a lot of the other videos that I've done where I try to explain in detail what we know and what we don't know, DeFi taxation solidly falls into the camp of we have no idea. So, there is no current IRS guidelines as to how we should be treating DeFi. That being said, most of what's happening in the DeFi space right now is not without precedent. So it looks pretty new, it looks pretty shiny, and it's a very new take on some old methodologies. But we believe here at Vincere Tax that you can create coherent arguments about how some of this stuff might be taxed. So let's take some examples. Please bear in mind that these are not recommendations. We do not have firm confirmation from the IRS on how this stuff is taxed, and we'll be using a case-by-case basis for our clients. So you take your ETH and you want to participate in ERC20 token, some sort of function, but ETH isn't in ERC20 yet. So what do? You wrap it into WETH. You use a wrapping function. You take your ETH, it goes away, and now you have WETH on the ETH blockchain. What happened here? Argument, this is not a taxable event. So this is effectively taking one type of asset and staking it. So you're taking your ETH and you're putting it locked away in a contract and borrowing WETH against it at a one-to-one loan value. So this is not actually trading in your ETH for WETH. You have not traded one coin for another. You have lent your ETH to a contract and it has generated WETH for you as a loan. This means you still have underlying exposure to your ETH. You could actually get it back if you wanted, right? You could reverse the transaction at a one-to-one ratio. So you could take your WETH and get your ETH back. It would keep its same cost basis. What about staking some of your assets on, let's say, in a Yearn vault? So you put your assets in a Yearn vault and start earning interest on them. So this is going to be taxable. Putting it into the vault is, again, staking it. This is not a taxable event. You still have exposure to the underlying asset. It's still your ETH. But the interest you receive from the Yearn vault is a taxable event, right? Every time you get that interest, that's money you didn't have before and should be taxed as interest. When you get your underlying ETH back, so you unstake your underlying ETH, the change in price between when you staked it and now should not trigger a taxable event, right? This is, again, using something as collateral. You still own it the whole time. Some other DeFi exposures one might have would be something like a hex contract, where you lock your hex up, you accrue interest over time, you get your hex back, and then you get the interest bonus as well. Again, interest bonus is taxable income. Underlying asset is still yours, right? You're exposed to it the whole time, does not cause a sale when it happens. If you use like a 1-inch exchange or one of the more complicated exchanges that kind of farms out what happens with your coins when you move from one coin to another, that is still absolutely a taxable event. You have traded one coin for another coin. There are many, many other DeFi transactions that we can go through in detail if you have them in your portfolio. And again, we're going to be case-by-case basis here because we don't have direct ruling from the IRS. Hope this was helpful.